Taking a look at Home Depot shares, the company reporting mixed first quarter results. Stock is higher though, earnings per share coming in below expectations, but revenue topping estimates up more than 9% year over year. The home improvement chain reaffirming its full year guidance. Really critical though, the company said it does not plan to raise prices amid the ongoing trade war. So how does that net out for investors? Joining me now, Michael Baker, DA Davidson Managing Director and Senior Research Analyst. Michael, great to have you on this morning. I got to start on the company looking to maintain prices. How can they do that and also maintain profit margins?
Well, they do have some offsets, and I think that's one of the keys to the story this morning. Things like lower shrink costs, better supply chain management, that is enabling them to offset some of the higher costs that they're paying from tariffs. They're also using what they call the portfolio effect. So in general and on average, prices won't go up. But I do think there'll be some areas where you'll see price increases, some areas where you'll see price declines, such that the average basket doesn't necessarily go up, but they can manage tariffs that way by looking at different pricing for different products.
So when you look at the balance sheet, then I'm curious how you're thinking about things like inventory pull forward. If they are going to follow this sort of diffusion model when it comes to pricing, is that inventory pull forward potentially a risk to the balance sheet in quarters to come?
It doesn't really seem like they pulled forward too much inventory. Now, inventory was up year over year, but part of that is a function of the acquisition, the SRS acquisition that they made last year. And they've also seen a little bit better demand over the last few months. In fact, April in the U.S. was the second best comp month that they've had going back at least a year and a half. So the inventory, while it might look high on the balance sheet, up, I think it was 15% year over year. Again, a lot of that was not due to pull forward, but just due to other factors. The majority, again, that big acquisition that they made a year ago.
And my guest host, Chris Versace, has a question for you, Michael.
So, sure. Michael, when you take a look at Home Depot's guidance and you kind of look at the soft housing market that we have right now, concerns about consumer spending, consumers kind of becoming increasingly selective, dialing back in certain areas, what's giving you comfort with Home Depot's outlook for the coming quarters?
Yeah, I think a lot of it, again, is the trend that we've seen the last few months. If you include the fourth quarter and now the first quarter in the U.S., so adjusting out currency, they've comped positively 2 quarters in a row. They've been negative going back to the post-COVID era when they lost a lot of sales because of the pull forward during COVID. So the last 2 quarters, positive comps in the U.S., and that included an acceleration within the first quarter. In other words, March and April were better than February, and some of that has continued into May. So we don't want to overstate it. They're certainly not comping at the level where they historically did in the 3 to 4% range, but they are flat to up slightly. In fact, maybe even 2% in April when you adjust for the Easter shift that they're closed on Easter, so that hurt April. And even with that, again, it was the second best month in about a year and a half. So they do have a little bit of momentum on the side, and that's what gives us comfort with the 1% comp for the year.
So tracking that momentum is going to be key for investors. What are some of the things that you'll be watching, in the next several weeks, several months throughout the summer to kind of get a feel that guidance is tracking?
Sure. Well, we have a number of leading indicators that we track on an inter-quarter basis and publish frequently. This is things like overall retail sales. We spend a lot of time looking at their vendors. A lot of their publicly traded vendors report a month before Home Depot does because they have a December year end, whereas Home Depot has a January year end. So we hear from Stanley Black & Decker, Masco, et cetera. That gives us good insight. We do get weekly point of sales data. So there's a lot of stuff that we track and we publish on. And that really does help us get a sense as to whether they're tracking in line or not. And if we see things waver, we'll adjust accordingly.
And Michael, I also want to look ahead to some of the other retail earnings that we have coming up, particularly when it comes to a company like Costco. How are you thinking about that retailer in this moment?
Well, Costco is doing exceptionally well. We know that. Remember, Costco is the only retailer still that still gives us monthly comps. So we have a very good sense as to how they're comping into quarters. So when they report it, it's really about margins. But when we look at the monthly comps, they're just taking a lot of share. Really, all the clubs are doing well. Sam's Club within the Walmart report last week was very strong. BJ's has been taking market share. In fact, BJ's has been one of the best performing stocks in our space year to date. BJ's stock is up more than Costco's. But all three of them are doing very well. The club space in general, just taking market share. in an environment where consumers are really focused on value.
And I guess I wonder if you can kind of put a bow on all of this for me here, especially as we head towards Target earnings. How are we going to see retailers sort of entering either the Walmart camp of admitting to raising prices versus the Home Depot camp of saying we're going to keep prices where they are? And what are the factors that you think different retailers are going to consider as they're deciding which camp to signal that they're going to be in to investors?
Well, it's very tricky, and you're right. To me, it's much more about signaling. I don't really think those two companies, Home Depot and Walmart, are doing things that much differently. It's just how it's articulated. I think Walmart wants to send a message perhaps to the administration that some prices will go up, and so try to help with the tariff negotiations, if you will, telling the administration that we really need some help on tariffs. But again, Walmart also will use a portfolio effect. In some areas, prices will go up, some they'll go down, and I think it'll be about neutral. But really, it's just about how much you want to sort of signal to the administration. And Home Depot just seems to be taking a more conservative approach to that. Walmart a little bit more aggressive. How other companies do it, Walmart really has the size, the scale, the credibility, whatever you want to call it, to really articulate that a little bit more effectively than I think some smaller retailers. That being said, smaller retailers, they might not have a choice. They might have to raise prices because they don't really have the offsets that the bigger retailers with scale have, i.e. pushing some of the tariffs back onto their suppliers.
And Michael, I want to end with something that Chris actually flagged to me on set earlier in some of his commentary, this idea that maybe these retailers will have a lift in the second half of this year if we do get these tariff negotiations. To what extent do you think investors are maybe underpricing a potential lift to retail stocks if we do start to see the tariff risk fade?
Sure. Right now we're pricing in a 30% tariff in China and 10% elsewhere, and I think that's a decent baseline. But if that 30% were to come down, you will see a margin benefit. You will see the retail stocks benefit. My guess is you'll see the entire market benefit. So I don't think that's priced in. I think what's priced in now, again, is that 30% China tariff. Anything better than that will, to me, absolutely be a positive, both for margins and stock prices.